Speaking of AI, we got to talk some Nvidia as well. While 90% of analysts say to buy this stock, even with this pullback, there's at least one doubter on the street in the names of Elliott Management, which had a letter that kind of leaked out. What did we find out in this report from the Financial Times?
Yeah, somebody's going to be, the one saying no to the stock, right, that keeps winning. And that's what Elliott Management is doing here. They talked about a potential bubble for the stock. They said the AI technology driving the chip makers' share price is overhyped. They said they were skeptical that big tech companies would keep buying the chip makers' graphics processing units in such high volumes, and that AI is overhyped with many applications not ready for prime time. They did say that many of AI's supposed uses are never going to be cost efficient as well. They're never going to actually work right and will take up too much energy. That's an interesting side of the story. I mean, it's hard to see that when you look at these earnings reports, when you look at the type of purchases we're seeing on Nvidia products. Just that last report alone, data center revenue up 427%. 86% of their total revenue. This has been an absolute impressive stock for quite some time. I know we've seen that pullback for the overall sector, but it's an interesting take for sure.
Big tech stocks are experiencing another challenging day as they face significant declines. After propelling the market to unprecedented highs in the first half of 2024, these megacap tech giants have now become some of the most substantial losers in a widespread global sell-off. This downturn, which began in earnest last week, has shown no signs of abating as it continued into Monday. The sharp decline in stock prices has raised concerns among investors, who are now reassessing their positions in these previously high-flying companies. Market analysts attribute this sell-off to a combination of factors, including rising interest rates, regulatory pressures, and concerns about overvaluation. As the market grapples with these challenges, the performance of big tech stocks will be closely watched as an indicator of broader economic trends and investor sentiment. So what's the fuss, and should you feel worried? That's what we will break down in today's video. But first, if you want to keep up with the Magnificent 7 stock's latest updates and keep up with the stock market's latest news, you can follow our Twitter account. We post multiple times daily about the biggest changes and catalysts in the market, so click the follow button if you don't want to miss the newest market updates. Now, back to today's video.
We're tracking Nvidia shares this morning. NVDA, the ticker symbol up on your screen right there. The shares are moving to the upside today after leading the declines in the Magnificent 7 yesterday, Monday, with those stocks shedding over $650 billion amid a steep global sell-off. The stock's volatile run over the last month here is leaving investors wondering if now is the time to buy. Let's bring in Patrick Moorhead, the founder and CEO of More Insights and Strategy, joining us now here. All right, so Patrick, I mean, is now the time to, if you're not already involved in some form or another and have exposure to Nvidia, is now the time?
Listen, giant sell-offs are always a huge opportunities for investors. When I stand back and when I look at the PE ratio, it's reasonable when you consider the growth rates. Their midterm competitive position hasn't changed from anything. And when I look at short term, there is a little bit of risk here with this potential Blackwell push, which is the follow-on to their H series. But customers can still continue to buy the H series. So even on the short-term risk, I don't see a tremendous amount of downside here.
The Magnificent 7 is a movie-inspired moniker that refers to the 7 tech giants: Alphabet, Amazon, Apple, Meta, Microsoft, Nvidia, and Tesla. This term became a popular catchphrase on Wall Street after these companies were responsible for half of the S&P 500's total gains last year, according to a report from Morgan Stanley. However, the recent market turmoil has hit these tech behemoths hard. By the close of trading on Monday, shares of all 7 companies had plummeted by at least 3% or more. This significant drop resulted in a staggering loss of over $600 billion in their collective market capitalization. This decline marks a stark contrast to their performance last year, when they were the driving force behind the market's gains. The substantial loss in value underscores the volatility and shifting investor sentiment that currently characterize the market. Factors such as rising interest rates, increased regulatory scrutiny, and broader economic uncertainties have contributed to the steep sell-off. As these influential companies navigate the challenging market conditions, their performance will continue to be a critical barometer for the tech sector and the overall market. Even before last week's disappointing U.S. economic data reignited fears of a recession on Wall Street, big tech stocks had already started to decline. Investors, anticipating a potential Federal Reserve rate cut that has yet to materialize, began reallocating their gains from tech stocks to more value-oriented sectors. The Wall Street Journal described this shift as a stock market rotation of historic proportions. Additionally, recent geopolitical tensions have significantly impacted chip stocks, particularly affecting Nvidia, a leading player in the AI sector. Nvidia's shares tumbled 7% on Monday, marking the worst performance among the Magnificent Seven. Despite this setback, Nvidia's stock has still more than doubled since the beginning of the year. But that's not all of it, so let's go through the rest. Hello everyone and welcome back to Investocracy.
So Patrick, I'm curious on what you attribute just the volatility to. It sounds like it's a bit of an overreaction. It sounds like you think that any sort of hiccup here, if we do see that in production, is going to be more of a short-term blip. Was this just a stock, just given the massive run-up that we've seen, which is primed and positioned here for this type of pullback, and then therefore, kind of going to your thesis of what you just said, it maybe does present a buying opportunity then for investors?
Yeah, you nailed it. I think on one of your previous shows, I even used the word hiccup. I mean, investors, that this stock was so hot for so long that any type of hiccup or bad news could mean a sell-off. And you add to what happened over in Japan and some other risks that melted the entire market. But you have to stand back and look at the overall short, midterm, and long, and then align whatever investment strategy you have with those opportunities and risks. I don't see anything changing in the data center for Nvidia for the next 12, maybe even 18 months. There is a little bit of short-term volatility until we understand what exactly is happening with Blackwell, which, by the way, could be an opportunity for AMD short-term, Broadcom, and maybe even Marvell to go in and grab some share. But that's a short-term, not a midterm, and then long-term, right? It's a totally different conversation.
Baird's Ted Mortensen previously informed Fortune that for the tech giants to have any chance of halting the sell-off, they needed to exceed expectations in their Q2 earnings reports. However, this did not occur, with Amazon notably underperforming on revenue and providing a weak sales outlook last week. At the same time, while investors have been frequently informed about the Magnificent Seven's substantial investments in AI, there has been little discussion on how this will immediately impact their revenue. Regulatory scrutiny has also intensified, highlighted by a federal judge's ruling on Monday that Google has illegally sustained a monopoly over search functions on Android and Apple iPhone devices. The most significant factor contributing to big tech's losses on Monday was a significant drop in Japan's Nikkei 225 index, which negatively influenced U.S. markets at the start of trading. Despite a partial recovery by midday, the information technology sector ended the day down 3.78%, according to Bloomberg, marking it as the worst-performing sector. On top of this, Apple's losses were in the spotlight after Warren Buffett's Berkshire Hathaway revealed Saturday that it sold almost half its position in America's largest company during the second quarter. Like many analysts, Infrastructure Capital Advisors CEO Jay Hatfield emphasized that Buffett's move was not cause for panic over Apple's viability. Hatfield noted his firm, however, thought Apple was overvalued at its recent high above the $237 mark. The iPhone maker's shares dropped almost 5% Monday to take the stock below the $210 mark. That value problem was enough for the Oracle of Omaha to dump Apple's stock, a move long anticipated by Berkshire analysts. It's not, Hatfield said, an indictment of the U.S. economy. The notion that we're going into recession because he sold Apple is patently ridiculous, Hatfield said. And even if an economic downturn does materialize, many analysts say Apple, and the rest of the Magnificent Seven, enjoy incredible market dominance and massive free cash flows that can make them relative safety nets for investors. Monday's sell-off doesn't change that. So should you feel worried if you are an investor in the 7 magnificent stocks? The answer is easy. But first, if you made it this far into the video, thank you. These videos take a lot of effort and time to make, so if you enjoyed them, please hit the like button and subscribe to the channel. This goes a long way in helping us grow. That said, back to the video.
It seems like some of the market's focus is going to shift towards China's economic data that's coming out this week. And the reason why I bring this up is this is going to be a pretense, perhaps, for the Nvidia earnings once they finally do report, given the significance of that region and continuing to tap into being able to put a specific chip for China made for that region into Asia Pacific as well here. What do you expect the reality of the pulse as prescribed via Nvidia to be about China and that market?
Well, it's kind of good news, bad news. The bad news was that earlier there were big restrictions and currently restrictions on companies like Nvidia, AMD, and Intel. And when you step back, because they're not participating, irrespective of what's going on with the China economy, it doesn't impact Nvidia a lot. I think the biggest thing that could impact Nvidia in regards to China is for the government to lock down on hyperscaler access, which has Nvidia GPUs in it, to China. Currently, Chinese companies can utilize US and Europe-based hyperscaler infrastructure as a service partners that have GPUs. I do think it would be an upside if Nvidia were to get government approval on this new tuned down version of their latest chips. So I think regardless of what comes out economically on China, if Nvidia gets the green light, it's good news.
The question of whether it's game over for the Magnificent Seven, Alphabet, Amazon, Apple, Meta, Microsoft, Nvidia, and Tesla, reflects broader concerns about their dominance in the market and the implications of their recent struggles. While these tech giants have been significant drivers of market gains, their recent downturn suggests they may face challenges moving forward. The current situation could signify a shift in investor sentiment, where the tech sector's previously unparalleled performance might start to level out. This could result in these companies sharing the spotlight with a broader array of stocks. Such a shift could mean that the investor enthusiasm once overwhelmingly concentrated on these 7 firms may now be distributed more evenly across various sectors and companies. From a market risk concentration perspective, this redistribution of investor interest might not be a negative development. Over-reliance on a small group of high-performing stocks can lead to heightened market vulnerability. If the fortunes of these 7 tech giants decline, they could disproportionately impact the broader market. By diversifying investment interests across a wider range of stocks, market risk could be more evenly spread, potentially leading to a more stable and balanced investment environment. Moreover, a shift in focus could encourage investment in emerging sectors and companies, fostering innovation and growth across different areas of the economy. This broader market participation could help mitigate the risk of a significant market correction tied to the performance of just a few dominant players. In summary, while the Magnificent Seven may face a period of adjustment, the potential for a more balanced and diversified investment landscape might offer a more resilient and less concentrated market, which could be beneficial in the long run. And finally, if you would like to know what the Magnificent Seven have been up to these past few days, go ahead and click on the next video on your screen. See you there.